As an investment advisor, I see a lot of portfolios. Not only am I evaluating my clients' portfolios on an ongoing basis, but I see a lot of prospect portfolios that need second opinions or trying to figure out where they stand. And so today I wanted to go through some of the mistakes that I see when I'm evaluating outside portfolios. So one of the biggest things that you remember is, for everybody, you kind of accumulate assets as you go. And, sometimes there's a plan behind that. Hopefully there's some type of strategy of where you want to go, at least a time frame of I want to retire at X date or X age or whatever that may be. But what happens over time, though, is, we kind of accumulate things. So maybe it's old 401ks, or we picked up an investment here that we liked, or we heard a tip here that we liked, and all of a sudden our portfolio can look very different than maybe what we were planning for. Especially when we can consider around getting to a certain date, like retirement or something like that. And so, retail investors aren't the only ones that have to be aware of the different risk out there. Even professional money managers can also run into the same thing. Narrative cycles, performance cycles, their own biases, whether it be emotional or within an investment that they believe in. Those are all things that, even professionals have to manage. But the things that I see most is number one, taking portfolio level risk without realizing. What does that mean? So basically, that means concentrating in a stock, a sector, or something along those lines, where all of a sudden, whatever that thing may be, it's really driving performance, whether that be good or bad. And it looks really good when performance is good, and you might all of a sudden put more and more. That's kind of how you tend to get really concentrated. But this is the thing that I see most often versus professional money managers is it's not diversified enough, too much risk within one name, again, driving all the outcomes, whether those be good or bad. Number two thing that I see is changing strategies when it matters most. So again, if our goal is a retirement goal, that we need X amount of dollars by X amount of date, and we've put together a strategy to get there. Well, then what happens over time is the markets are going to do whatever they're going to do, sectors are going to do whatever they're going to do, good or bad. And what happens is you start chasing. And, maybe that means you have a sector that is hot. Think of maybe something like AI over the last few years. So all of a sudden you're putting more money in toward that. You're getting away from your original strategy. And again, going back to issue one is getting over concentrated in other areas. And that could be the other direction as well, is, taking risk off the table. We just went through a bit of a market correction. Did you take money off? You didn't want to lose any money. Now, when do you get back in? Again, not following the strategy over time. And then the last thing is letting emotions dictate timing. And again, talk about that a little bit of changing strategies. That's the hardest time is to not make a decision is when things are going in the opposite direction that you think they are. And so, again, letting the emotion take over, not following your process or whatever that may be, or whatever that strategy may be. And so this is the thing that over time and time again, that all the studies show that investors jump in and out, they get out at the wrong times, they sell at lows, they buy at highs. And again, the emotions are driving those decisions instead of the strategy that you had to get there. And then finally, the biggest difference between what I see in retail investors and more professional money managers is a system, a presence of a system. And, again, that can be called a strategy, that can be called whatever else, but it's having a system, following the system, benchmarking the system, and making sure that it's working toward whatever that goal may be. And that could be short term, long term, whatever it may be. But that is the biggest thing I think is the difference is following that system, or being, brutally honest about it, is having any system whatsoever. And so instead of, just kind of following the narratives in the paper or the internet of, what's the thing to buy, what's the sector to be in, We follow a system that is based on where we're trying to get to. So questions on this, always feel free to reach out. Be happy to answer any questions. Other than that, I hope you have a great week, a great month, and we'll see you soon.